Visa Incorporated, ticker V on the NYSE, the company that processes $14.8 trillion in payments annually, connecting 4.3 billion cards to 130 million merchant locations across 200-plus countries.
Founded in 1958 as Bank Americard, headquartered in San Francisco, California, 26,500 employees, one of the highest operating margin businesses in the S&P 500 at 67%.
Bank of America launched Bank Americard in 1958, the first mass-market credit card program, dropped unsolicited into 60,000 Fresno households. It was chaotic, but it proved that consumers would use a plastic card instead of cash.
In 1976, the network was renamed Visa to reflect its global acceptance ambition. In 2008, Visa went public in the largest U.S. IPO in history at the time, raising $17.9 billion and separating from its bank-owned consortium structure.
In 2016, Visa reunited its global network by acquiring Visa Europe for $23.4 billion, ending 40 years of separate operations and creating a single worldwide payment infrastructure for the first time.
Ryan McInerney became CEO in 2023 after a decade as president of Visa. In 2024, the DOJ filed an antitrust suit challenging Visa's debit market practices, the primary regulatory risk facing the business.
Visa generated $35.9 billion in fiscal 2024 revenue. Data processing revenues, transaction fees account for 47%. Service revenues from payment volumes add 42%. International transaction revenues contribute 11%.
Operating margin reached 67.2% in 2024, one of the highest in the S&P 500. Adjusted EPS grew 13% year over year. The fixed cost infrastructure processes more transactions each year at essentially the same underlying technology cost.
Total payment volume reached $14.8 trillion in fiscal 2024, up 8% year over year. Processing 250-plus billion transactions from 200-plus countries generates a fraud detection dataset no alternative network can match.
Visa is accepted at 130 million merchant locations globally. A merchant who does not accept Visa excludes 4.3 billion cardholders. A cardholder who does not use Visa loses access to 130 million merchants. This bilateral lock-in took 65 years to build.
Visa has raised its dividend for 16 consecutive years. Starting at 52 cents annually in 2015, the dividend reached $2.08 annually by 2024, more than quadrupling over the decade, while the payout ratio remained conservative.
The total annual payout reached $4.24 billion in 2024 at a current yield near 0.8%. A $25 billion active share repurchase authorization amplifies per-share earnings growth beyond the organic revenue growth rate.
On the competitive radar, Visa leads all peers on payment network scale at 98 and merchant acceptance at 95. MasterCard scores nearly as high. The two companies effectively share a duopoly on global payment rails that took 65 years to build.
American Express scores highest on regulatory resilience at 80, given its closed-loop network model. Visa's regulatory resilience score of 72 reflects the ongoing DOJ antitrust scrutiny of its debit market practices.
Visa's network connects 4.3 billion cards to 130 million merchants across 200-plus countries through 14,500-plus issuing financial institutions, processing peak volumes exceeding 65,000 transactions per second on the VisaNet infrastructure.
Cross-border transactions are the highest margin revenue stream. Every tourist, business traveler, and e-commerce purchase across a currency border generates incremental Visa revenue, and global travel expansion compounds this stream over time.
Ryan McInerney earned a BA from Notre Dame and an MBA from Columbia Business School. He joined J.P. Morgan Chase in 1999 in consumer banking and cards before joining Visa as president in 2013 and becoming CEO in 2023.
The $100 trillion B2B payments market is 97% cash, check, or wire. Visa B2B Connect and Visa Direct are opening payment infrastructure access to commercial flows that card rails have never touched before. Visa processes $14.8 trillion in payments annually. That number is almost impossible to contextualize, but it means that every 75 seconds, Visa settles more money than most companies earn in a year. through a fixed cost network that gets proportionally more profitable with every incremental dollar of volume.
The DOJ antitrust lawsuit is the one thing that can break the thesis. Visa's debit market practices are under legal scrutiny, and if the court forces network unbundling or fee caps, it would structurally alter the economics of a business that has otherwise looked impervious to competition for 65 years. Visa Inc., ticker V, reported Q2 FY2026 net revenue of $10.16 billion, up 6% year-over-year. The world's largest payment network processed 62.6 billion transactions across $4.35 trillion of global payment volume in a single quarter.
Non-GAAP EPS 309 beat the 301 estimate by 2.7%. Revenue of $10.16 billion beat the $10.04 billion consensus by 1.2%. Cross-border volume, Visa's highest margin segment, grew 15% in constant currency.
Visa earns a toll on every tap, swipe, and online checkout across 200 countries. Zero credit risk, no inventory, 67% operating margins. It connects 15,000 financial institutions to 4 billion cardholders and 130 million merchant locations worldwide.
Visa trades at 27 times forward earnings, $693 billion of market cap. Is the payments duopoly fully priced, or does the digital commerce revolution still have decades of runway? We break it down.
Three forces defined Q2 FY2026. First, cross-border acceleration. International transactions grew at double the domestic rate as global travel remained above pre-pandemic levels. Cross-border carries roughly 3 times the yield of domestic payments, making it the highest margin revenue driver in Visa's portfolio.
Second, value-added services momentum. Data analytics, fraud prevention, consulting, and Visa Direct real-time transfers grew 17%, now 26% of net revenue and the fastest-growing segment on the network.
Third, shareholder returns at scale. Visa repurchased $4.5 billion of stock in Q2, reducing diluted share count to 2.1 billion. Combined with the quarterly dividend, total capital returned was approximately $5 billion, an annualized yield exceeding 5% of market cap.
Payment volume grew 8.8% globally, despite macro uncertainty. U.S. volume gained 6%, led by services and e-commerce. Debit outperformed credit, reflecting the consumer preference for pay-now spending that has persisted across the economic cycle since 2021.
Europe grew 6% on tourism recovery. Asia-Pacific ex-China gained 11%, the fastest regional growth, as post-pandemic travel recovery continues compounding. These markets remain below structural ceilings and represent decades of cash-to-digital digitization runway ahead.
Operating margin held at 67.5% non-GAAP, flat from Q2 FY2025, as Visa maintained expense discipline. Personnel costs grew in line with revenue, technology and marketing investment concentrated on AI-enhanced fraud detection and digital commerce enablement tools.
Net revenue mix in Q2, service fees 43%, data processing 38%, international transaction fees 26%, offset by client incentives at 10% of gross revenue. International transaction fees grew the fastest at 15%, driven by cross-border volume.
Net revenue $10.16 billion, up 6% from $9.59 billion in Q2 FY2025. This beat the $10.04 billion consensus by $120 million. Payments volume, transactions, and cross-border all delivered positive surprises relative to street estimates.
Non-GAAP net income, $5.52 billion, up 9% year-over-year. Non-GAAP EPS 309 beat the 301 estimate. GAAP EPS was $287, lower due to non-cash litigation provisions and client incentive timing adjustments not in non-GAAP.
Payments volume, $4.35 trillion globally, up 8.8%. U.S. $2.2 trillion, up 6%. International $2.15 trillion, up 12% constant currency. International now represents 49% of total payments volume, up from 46% 2 years ago.
Cross-border volume grew 15% constant currency. This segment, transactions where merchant and cardholder countries differ, carries a yield 3 times domestic rates. Travel, international e-commerce, and B2B cross-border payments all accelerated in the quarter.
Transactions processed, 62.6 billion, up 6.7% from 58.7 billion. Visa averaged 685 million transactions per day globally. Debit and credit both grew at mid-single-digit rates, reflecting broad consumer spending across income tiers.
Service revenue, 4.37 billion, up 5%. Data processing, 3.86 billion, up 7%. International transaction revenue, 2.64 billion, up 15%. These three lines grew in proportion to their respective volume and transaction drivers.
Client incentives paid to banking partners and large merchants, 1.12 billion, treated as contra revenue. These rebates grow proportionally to partner scale. Net revenue after incentives was 10.16 billion, consistent with the volume and yield arithmetic above.
Value-added services revenue, 2.64 billion, up 17%. Visa Direct real-time transfers, tokenization fees, cybersecurity products, data analytics, and open banking APIs all contributed. This segment is now 26% of net revenue and growing 3 times faster than core payment volume.
Non-GAAP operating income, 6.86 billion at 67.5% margin. Operating expenses, 3.3 billion, up 3%, half the rate of revenue growth. Visa's fixed cost network means every incremental transaction dollar falls almost entirely to operating income.
Q3 FY2026 guidance, high single-digit revenue growth, low double-digit non-GAAP EPS growth. FY2026 full-year outlook reaffirmed 8 to 9% revenue growth, approximately $12.20 non-GAAP EPS. Management reaffirmed confidence in the full-year trajectory and did not adjust volume assumptions.
Free cash flow, 21.5 billion trailing 12 months, a 3.1% yield at 330. Visa generates far more cash than it returns to shareholders. The surplus funds tuck in fintech acquisitions. Regulatory complexity is the primary constraint on capital deployment at this scale.
Balance sheet, 21.4 billion cash, 20.9 billion debt, essentially net flat. Total equity, 38.5 billion. Visa carries modest leverage deliberately to fund buyback programs while preserving capacity for compliance events and strategic acquisitions.
Ryan McInerney became Visa's CEO in February 2023, succeeding Alfred Kelly. He joined from Citigroup, where he led North America Consumer Banking, one of the world's largest retail banking franchises.
On the Q2 FY2026 call, McInerney emphasized expanding Visa beyond card present, real-time transfers, cross-border B2B, and embedded checkout. Quote, "The opportunity in front of us is orders of magnitude larger than traditional card payments."
McInerney outlined 3 strategic priorities: scaling Visa Direct real-time transfers to 5 billion transactions annually by 2027, expanding value-added services margins above the current blended rate, and tokenization penetration. Visa has tokenized 6 billion network credentials, cutting fraud 40% at tokenized merchants.
On real-time payment rails, McInerney was direct. We partner with FedNow, Pix, and UPI. Visa's network adds acceptance, fraud protection, and dispute resolution that account-to-account rails cannot. Full-year EPS guidance of $12.20 was reaffirmed with high confidence.
Let us build the P&L from gross down to net. Gross revenue before incentives, 11.28 billion. Client incentives subtracted 1.12 billion, landing net revenue at 10.16 billion. The incentive ratio of 10% held flat year over year.
Service fees, 4.37 billion, paid 1 quarter in arrears on prior period volume. This lagged structure means Q2 service fees reflect Q1 volume. The full Q2 acceleration appears in Q3 service revenue.
Data processing fees, 3.86 billion. Visa charges 4 to 6 cents per transaction for authorization, clearing, and settlement. At 62.6 billion transactions, processing revenue grew in lockstep with transaction count at 7%.
International transaction fees, 2.64 billion, up 15%. This is the premium yield on cross-border volume, approximately 1% on each dollar of international spend. Foreign exchange conversion and international compliance services justify the premium over domestic processing rates.
Other revenues, 55 million. These are miscellaneous items, including real estate sublease income, one-time service fees, and residual item processing. The minimal contribution from this line reflects how cleanly Visa's revenue architecture concentrates around three core payment streams.
Cost structure: personnel costs $2.0 billion up 4%, technology $800 million up 5%, marketing $300 million flat. Total non-GAAP operating expense $3.3 billion, exceptional leverage on a $10 billion revenue base.
Non-GAAP net income $5.52 billion at a 54.3% net margin. Tax rate 19.5%, benefiting from offshore earnings treatment and stock-based compensation deductions. The effective tax rate has held between 19 and 21% for 3 consecutive fiscal years.
Capital allocation in Q2, $4.5 billion in share buybacks, reducing shares from 2.12 billion to 2.1 billion. Combined with the $500 million quarterly dividend, $2.52 annualized, Visa returned approximately $5 billion to shareholders in 90 days.
The tokenization story is a hidden, compounding driver. Visa has tokenized 6 billion credentials, replacing static card numbers with dynamic tokens in digital wallets. Token transactions carry higher authorization rates and lower fraud losses, improving economics for all participants.
Visa Direct real-time push payments processed 5 billion transactions in the trailing 12 months, up 22%. Use cases: gig economy payouts, insurance claims, peer-to-peer transfers, government benefits. Each Visa Direct transaction carries a margin profile comparable to cross-border processing.
B2B payments represent the largest underpenetrated opportunity. Global B2B transaction volume exceeds $120 trillion annually. Less than 3% flows through card or digital networks. Visa's B2B Connect platform for large enterprise cross-border commercial payments is in early commercial rollout.
FY2026 model, revenue approximately $40.6 billion, non-GAAP operating income $27.4 billion, EPS $12.20. The guidance embeds 1.5% share reduction from buybacks and 8% operating income growth.
Visa competes primarily with MasterCard, a near-identical model and duopoly partner. Visa holds 54% of U.S. credit volume and 60% of global debit. The two effectively co-own the global payment network layer.
MasterCard trades at 30 times forward versus Visa's 27, a modest premium for faster growth and higher cross-border mix. Visa's cross-border acceleration has closed the growth gap, compressing the valuation spread over the past year.
American Express competes in premium credit, not a direct network rival, but a brand substitute at the high end. Amex's closed-loop model creates higher per-transaction yield but limits merchant acceptance to 70% of global locations versus Visa's 93%.
PayPal, Block, and Stripe operate on top of Visa's rails, not against them. Most digital wallet transactions settle on Visa or MasterCard underneath. The fintech ecosystem has grown Visa's addressable market by digitizing commerce previously conducted in cash.
Real-time rails, FedNow, Pix in Brazil, UPI in India, are the most cited competitive threat. These systems bypass Visa for peer-to-peer transfers. Merchant acceptance, chargeback protection, and fraud resolution favor Visa for retail and commercial transactions.
Cryptocurrency and stablecoin payments are a hybrid. They can bypass Visa's network for settlement, but Visa has partnered with Circle and Coinbase for branded crypto cards, recapturing the consumer interface. Crypto card volume on Visa's network grew 40% in the trailing 12 months.
The MOAT metric, acceptance endpoints. Visa is accepted at 130 million merchants versus MasterCard at 110 million and Amex at 70 million. Closing this gap requires decades of distribution work and billions in incentive payments.
The primary regulatory risk: debit routing under the Durbin Amendment. Merchants can now route debit to competing networks, Interlink, Star, or Pulse, instead of Visa. Impact has been manageable. U.S. debit market share declined less than 2% since the rule took effect.
The DOJ antitrust investigation into Visa's debit practices is the ongoing overhang. The DOJ alleged Visa blocked routing alternatives through contractual restrictions. Visa settled a portion of the claims, but the full scope and potential remedies remain unresolved.
EU and UK interchange caps, 30 basis points credit, 20 basis points debit, have compressed Visa's European yield. Visa's response: grow cross-border and value-added services where no regulatory cap applies as a share of European revenue.
Cross-border deceleration is the top near-term risk. 15% Q2 growth partially reflects post-pandemic travel tailwinds. As the base normalizes in FY 2027, cross-border growth converges toward the low single-digit rates seen pre-COVID.
Visa's macro sensitivity is asymmetric. It earns on volume, not credit. A recession reduces payment volume but creates no credit losses. A 10% volume decline reduces revenue 6%, absorbed within the 67% margin with limited earnings impact.
Options market, implied volatility ranked 22, low for a blue-chip defensive grower. Put-call ratio 0.8, slightly defensive. Pre-earnings showed modest call buying at the 340 and 350 strikes, consistent with measured institutional optimism.
Visa's dividend has grown 36 consecutive years, a dividend champion. The payout ratio of 22% is conservative relative to 67% margins, leaving capacity for dividend growth well above the current 10% annual rate.
Analyst Consensus 30 buy, 5 hold, 0 sell, one of the highest conviction ratings in the S&P 500. Average target 380, 15% upside from 330. Range 325 to 430.
JP Morgan rates Visa overweight at 410, citing cross-border recovery and value-added services momentum. Their model projects FY 2027 EPS of $13.50, implying 22% growth over 2 years from the $12.20 guidance.
Goldman Sachs rates Visa buy at 380, emphasizing Visa Direct as the underappreciated growth driver. Goldman's proprietary spending data showed Visa volume growth above consensus in the 5 weeks before Q2, foreshadowing the revenue beat.
Morgan Stanley rates Visa overweight at $400, making it a top pick in payments. MS highlights the B2B opportunity. Capturing 2% of the $120 trillion in global B2B volume would add over $12 billion to annual revenue, nearly 30% of today's total.
The bear case from the 5 hold ratings. 27 times forward earnings is a decade-high premium for 6% revenue growth. Bears argue MasterCard's higher cross-border mix and faster payments volume growth justify MasterCard's premium, making Visa relatively less attractive at current relative valuations.
Post-earnings, Visa was up 2% on the day, a muted reaction to an inline quarter. The maintained guidance and stable margins were not catalysts for multiple expansion. The stock appears to have largely priced in the Q2 results, given its strong prior 6-month performance.
The consensus EPS trajectory, $12.20 for FY 2026, up 9% from FY 2025. FY 2027 consensus, $13.40, another 10% step. This implies Visa can compound earnings at high single to low double-digit rates for at least 2 more fiscal years at current volume growth assumptions.
The bull case in 3 parts. First, penetration runway. Only 40% of global commerce flows through electronic payments. In emerging markets, the cash-to-digital transition is accelerating. Each percentage point shift adds approximately $1.5 billion to Visa's addressable volume base.
Second bull pillar, value-added services expansion. At 26% of revenue growing 17%, this segment reaches 1/3 of total revenue by FY 2028. Higher margins than core fees structurally lift Visa's blended operating margin above 68%.
Third bull pillar, buyback compounding. Visa retires 6 to 7% of float annually. Operations plus buybacks deliver 14 to 17% total EPS growth annually, implying $450 to $500 by 2030 at a flat multiple.
The bear case in 3 parts. First, antitrust. If the DOJ restructures Visa's debit routing arrangements, the U.S. debit segment, approximately 25% of processing revenue, faces repricing risk of 10 to 20%. This scenario represents the largest binary risk to the thesis and is not priced into the current multiple.
Second bear pillar, real-time payment cannibalization. In markets with strong domestic RTP infrastructure, Brazil's Pix, India's UPI, the Netherlands' Ideal, Visa's domestic debit volume is structurally declining. If FedNow achieves consumer adoption above 10% in the U.S. by 2028, U.S. debit growth could compress toward 0%.
Third bear pillar, multiple compression. Visa at 27 times forward earnings prices in near perfection. any revenue growth deceleration below 6%, from cross-border normalization, macro slowdown, or regulatory disruption, would likely compress the multiple to 22 to 24 times, implying 15 to 20% downside from current levels.
Bottom line on valuation. Visa's 25% premium to the S&P 500 is justified by the network moat, low capital intensity, and the secular digitization trend, but requires continued execution. A single missed cross-border quarter would reprice the stock sharply.
Bottom line on Visa, Q2 FY2026 confirmed the payments toll road thesis. $10.16 billion revenue, 67.5% operating margin, and $21.5 billion in trailing free cash flow. Cross-border grew 15%, value-added services grew 17%, and the balance sheet is essentially net flat. 2/3 of global transactions remain in cash. Visa is the infrastructure play for 3 decades of that transition.
30 buy ratings, 0 sells, average target 380, 15% upside from 330. The bull case, EPS compounding at 14 to 17% annually from operations plus buybacks reaches $19 to $22 by 2030, a $450 to $500 stock at 23 times earnings. The bear case, antitrust or macro compresses the multiple to 22 times, implying 305.
Charged Alpha is an educational commentary podcast. None of the content here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. We do not hold positions in securities discussed on this show. Always consult a licensed financial advisor before making any investment decisions. Securities mentioned are for educational discussion only and are not buy or sell recommendations.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.